morning, everybody, and welcome to the Fred Report technical conference call for December 15th, 2011. We've had a little bit of volatility, but the net result in the stock market is we have filled the 122 area gap. I don't like these sorts of big up opens. I think we're going to trade up into Friday, but we could come down and fill this morning's opening gap a little bit. But the downside short-term objective is done. We are sticking, however, with our forecast that the end of the year is going to gradually die off and not be overly dramatic. We've been using a closing number for ourselves on the S&P. They always say do not forecast, exactly. So we are using a potential close of 1222.69 for the close of the year, which is a little bit up from here. And obviously I'm being somewhat facetious, but I do think we're going to close in the 1220, 1230 area this year. And if we do that, I'm still working up my stuff for next year, but next year looks to be a better year for the markets, I think, than people are expecting, especially the U.S. markets, and we'll talk about that in our year-end piece as well. But one of the things that we are seeing, we've mentioned this in seminars around the country, but not really on the call lately, is we are seeing European money coming out of the euro, and we think it is going into our stock market. We also think, and we've had some questions on emerging market stuff, emerging markets are acting much less attractively than U.S. stocks, and we think that one of the silver linings for next year is that speculative money is going to move into U.S. small and, to an extent, mid-cap sectors. So we're pretty excited for the U.S. market. It could be choppy, but we think next year is going to be a pretty good year so far. As far as the remainder of this year, again, probably flat, probably not much. We note that the stochastic on the daily is coming down. We're at 52. When that stochastic gets down into the 24 area or so, we can probably add some positions. Don't forget that the stochastic can also come down, not from downward price movement, but from sideways movement as well. In other words, if we trade sideways and don't do so much here, you may very well see that stochastic come down into the 24 area. Let's talk a little bit about the bond market. TLT, it has not made new highs yet, but oddly enough, the accumulation model continues to do extremely well. It's made new highs, so we would expect the TLT back up in the 124, 125 area by the end of the year. We don't think there's going to be a big switch. I think people are putting, money into stuff for year-end, window dressing reasons. So we don't expect this bond market to really do much before the end of the year. The indicators are very overbought, but the accumulation model says still an uptrend. And that's really our only concern about the stock market is this bond market is forecasting that we could have some stock market problems. So I would be holding some cash out in stocks if we get some kind of a dip to buy. But I'm not in a hurry to rush in and buy stocks here. But I'm dying to see what happens to this bond accumulation model up until the end of the year. Obviously, commodities had a very strange day yesterday. The DBC fell off. Gold really fell off. And gold is basically near the 150 to 145 area support on GLD. Let's talk for a minute on what happens with these commodities when they start to get down. Margin in commodities is different for most stock people. It's not a 50% down payment on the commodity. It's a good faith deposit of 3 to 5% generally. And what happens with commodities is if you do get a margin call, you have to meet that call with cash the next day. There's no Reg T filing and all that. You have to meet it the next day or you're sold out. The money actually leaves your account physically. Your account balance goes down or up depending on how they do. So when you get a stop running thing on a commodity like gold, especially for people that are under margined, the selling can be very intense at the beginning of a move, not at the end. Usually in stocks, the real violent selling occurs at the end of a move when people are giving up. In commodities, especially if there's a lot of retail interest in the futures, that really violent selling has a tendency to happen at the beginning of a move. So we're looking at this primarily as a move down in gold that is probably going to be viable again. We will maintain our 9-month target of 210. We note on GLD or 2100 on the COMEX contract, whichever occurs first, we note that the daily stochastics have come down on all these commodity ETFs pretty much that we follow, like DBC and GLD, down into the 15 area. And when those turn up, we would be very interested in purchasing those, and that's going to be what our plan will be. In terms of the dollar and currencies, no surprises for us here. The UUP and the dollar continue to go up. We have upside targets on UUP in the 23.50, 23.60, and then 24.40, 24.50 area. On the dollar index, that would correspond to roughly 83 to 85. We definitely think that's doable. We thought it would be doable for some time. I do remind people that the Japanese government also has said that they're going to lower the value of the yen. That's FXY, and FXY looks like it can come down. As long as FXY holds 115, by the way, it's at an uptrend, and since it's at 126, that could be a pretty big move. So we like the dollar. The dollar, I think, is a good hedge for stocks right now, although we are expecting the relationship to switch so that the dollar and stocks go up together next year. And we note that if you read our monthly last month, the research piece, there is no correlation between the dollar and stocks at all.